When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about what retirees and investors should be watching for in the next 30 days. We'll also answer listener questions. And finally, gifting money to adult children, give now or later. My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom is solid advice. They come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. How are you doing?
I am doing fantastic now that we're together on the radio again. And boy, have we got a good show lined up for the folks here in the greater Tucson area. It is June, and hopefully people are keeping cool and keeping their radio hot. Jeff, every day we're bombarded with economic headlines, market headlines, and geopolitical headlines. And for retirees and people approaching retirement, what do you think are the biggest things that we should be watching out for over the next 30 days or so?
Well, I don't think they're any different the next 30 days than forever, but you've certainly got the inflation is a big deal. Whether we get that war over there in Iran settled, we saw oil pop earlier this week and start to head back up the other direction. It was over, $100, then it was down to under that. And then, I don't know, it's just going all over the place. I don't know what to make of it. The market is going crazy. The market, they've got stocks that come in with good earnings and the stock goes up 30 or 40%, gaps up the next day, and then follows through. It used to be that it would gap up 5 or 10%, and then it would settle back down and then get back on its upward trajectory. Other companies it's like a feeding frenzy. There's a lot of stuff going on that I think we ought to be really vigilant of, and we're probably more in tune with what's going on in the market right now, just based on just the volatility and just the craziness we're seeing. The irrational exuberance is probably a minor word or minor way to state it. But there's things that play into that. And a lot of that is just what comes out of Trump's mouth. Every time he mentions a company, the stock goes through the roof because he acts like he's going to give him money or give him some sort of a break. Intel is an example of that, trading in the $20 range a year ago, and now it's over 100 just because the sovereign wealth fund decided to put some money into it, and he started touting that company. Every time he talks about Dell, all of a sudden Dell's up 100% in just a few months, and it's up 30% in a day. So there's some weird things happening that don't really connect to all this talk about inflation and people can't pay their bills and all these other things. You got the June inflation report, just to name the economic numbers that are going to come into play and probably cause market swings every time there's a rumor about it or there's a news about it. The June inflation report, I think just because gas prices have been high for a while, they typically kind of lag. So I think we'll see the high price gas from the last couple of months filter in. I wouldn't be surprised if it's pushing 4%. I hope it's not more than that, but it'll probably be 3 something, I'm guessing. Fed Reserve meeting, what's the posture? Are we going to raise interest rates? Are we going to lower interest rates? I think Trump certainly wants the new Fed chair to start lowering the interest rates just because it helps the economy, makes the market look good, which makes him look good. He can always tout that. Doesn't really matter if the regular people pay their bills anymore or if inflation's a real deal anymore. It's just really more about the market and how rich his friends get. And I hate to sound like I'm a down on Trump guy, but I think he's forgetting why he ran and who he represents a little bit as he gets a little more into the system and realizes what a big player he is in the market, maybe taking it a little bit too seriously. We've got to keep inflation under control too, and it might mean raising interest rates instead of lowering them. Raising interest rates could even crash the market like it did in 2022. We had to raise interest rates. We had inflation going crazy, and the only way to stop it is raise interest rates, and that typically puts more pressure on companies. Nevertheless, we've seen interest rates high for a few years now, and the companies still seem to be touting record revenues and making sales and buying the future AI chips and all the infrastructure that goes along with it. So we are seeing some legitimate growth in some of those fields, but only the people that own stocks and big 401ks are probably taking advantage of that right now. Unfortunately, people that are a little bit risk averse might not be taking advantage of it. or the up-and-comer young family who doesn't have a 401k yet, doesn't have disposable income, can't take advantage of that, and they're just seeing the inflation. That's kind of sad. Yeah, we're looking at just the on-again, off-again relationship with this war in Iran. I saw Marco Rubio on TV a couple of times talk about, we just got to really start talking with China and get them on board with the same goals because we're the two biggest powers in the world. And we need to get in sync with them and maybe put some pressure somehow on Iran, although I don't think it's going to happen from China's standpoint. But if we can just kind of settle the economy down, get more in sync with the value of the common everyday person instead of government power, I think we'll sit a little bit better. But again, oil prices going up and down. Gold, silver's been soft lately. What happened to that? It was going to go through the moon, and it's kind of settled down. Are central banks still buying it? I don't know. Is it really an inflation hedge? Do we need one? I don't know. Treasury yields going up or down? Well, that probably has something to do with the Fed meeting and what kind of either a hawkish approach comes, like I think probably should in light of the inflation, but they might be a little more dovish, might a little be more accommodating. And if that's the case, the market will continue to do well and inflation will probably get out of control again, and I hope it doesn't. Treasury yields, we're seeing those. They were going up for a little bit as some of the smart money was exiting the market, taking profits and moving into treasuries. We're seeing that kind of not be the case. And I'm not sure where bond yields are going to go, but I know bond market's been flat to down more than it's been up in the last several months. And so even the safe havens are not really a super attractive place to go right now, other than the fact if you're scared and you can't take risk, then maybe it is. There's always other safe investments that we use, the principal protected investments that can also shelter your money from the downturn in the market, but still get the upside while it's there. But all these things, these economic things coming through, we've got economic indicators. The leading economic indicators index is still on a downward slope. If you look at the overall view of that, there's a few sectors that may do good in the economic indicators, but the majority of them aren't doing well. And so it doesn't really look like the economy's buzzing, but the market's doing well, setting records. AI seems to be doing okay. Semiconductors were doing really well. Real estate's been flat because interest rates have been up. Is there going to be a rebound in that? I don't know. Anyway, there's just a lot of things that are out there. Yeah, June's a busy month, not to mention some midterm elections and things like that that are going to probably have some sort of a bearing on people's sentiment and the way things are going and what might happen market-wise. So it's always fun, as a manager of a lot of assets, we watch it every day and we try to bob and weave and move with those forces and try to get out of the way of the negative ones and try to jump on the ride when it's going the right direction. But again, you've got to be careful. You got to be able to get off at the right time and not ride this market down when it decides to correct. And I think we're still more and more in that, the rubber band's being stretched. And I think we're just closer and closer to that time when there has to be something happen. Some of the smart money is acting like it's already underway. You've got big hedge fund managers going to cash, selling huge positions, consolidating their funds from 40 or 50 different positions down to 20 or 30 or less, just to hold some of those blue chips that they think are going to be more stable through a potential market correction. And the thing is, things are so overvalued, I think it has to happen. But then again, until it does, we're going to still try to follow the money and do the best we can in this market. But man, if you don't get dialed in and watch it every day, I think you should be a little bit worried. So I guess that's my take on your first question. There's a lot of things happening. I think just the market forces and the different things that are moving it, the wind direction changes every day and the market seems to change every day. Each sector seems to be hot and cold on different days. Sometimes they change twice or three times in the same day. And it's much, much quicker than it used to be. Used to be you can kind of read the tea leaves a little bit, but by the time you read the tea leaves, there's a whole new story going on. So that's what we got to look forward to this month, along with a bunch of vacations and kind of weird markets. Usually when summer vacation starts, the market gets kind of weird and choppy because it's thinly traded. Small developments can mean big moves because maybe there's less trading. Sometimes there's more trading. We don't get the balance in the market that we sometimes get when we typically get through the September, October, through the May timeframe when it seems like everybody on Wall Street is working instead of playing.
Jeff, you talked about inflation currently as we sit right here today, about 3.8%. Of course, we're going to get the June inflation report shortly, and we're hoping that it isn't much higher than that, but it very well could be. And of course, inflation affects retirees in that their purchasing power certainly is going to be less and less. But I want to talk about the Federal Reserve here. Of course, Jerome Powell is out. Kevin Warsh is in. We do have a Fed meeting June 16th and 17th. Jerome Powell would push back against Trump about lowering rates. What do you think Kevin Warsh is going to do? Because Warsh is more in line, I think, with what Trump wants.
Well, I think he wants to be as the new guy. I think every time the new guy, look at Powell was pretty much in sync with whatever the president wanted for the first couple of rounds too. But then he got oh, well, I'm out of here anyway. I might as well do what I think. And he didn't like Trump, so he put his foot down and puffed his chest out and had a little power trip and bucked the will of the president, which they're actually supposed to do. They're supposed to be independent. The Fed is really just a banking referee that helps the big people, the Vanderbilts and the Rockefellers and Rothschilds all stay rich because they own all the wealth in the world. I'm kind of exaggerating, but it's not too far from what I'm saying, is the Fed really isn't supposed to be a government agency, yet it keeps the banks regulated and it gives the rich people control over the monetary system through the Fed, not really the president or who's in the White House, even though they appoint the Fed chair. I think it's the big money people that really do. And if the big money people are a little anti-Trump, the Fed chair might get anti-Trump, and Warsh might find himself maybe changing teams down the road a little bit. But right now he has to keep in good graces of Trump. Trump appointed him, so we'll see what happens. But there's certain things that always seem to happen when inflation gets out of control, and that is the interest rates kind of have to be raised just to kind of cool the economy down and cool the inflationary pressures. Love to see the supply catch up. I think tariffs did a lot to help that, but now they're trying to reverse those. Tariffs doesn't seem like it's a supply killer. No, it actually creates more incentive for companies to bring their manufacturing back home to America, where it's cheaper comparatively to foreign plus tariffs. And I think we're going down that road on a pretty good level, but that got upset with some activist judges that are trying to undo Trump's goals. And maybe they're right, maybe they're wrong, but whatever it is what it is. It's a fight now. It's not just an automatic deal. So maybe we'll go back to having import goods. Maybe the economy here, because of manufacturing that's not being brought back like we thought it was, may not come back. We might not get that supply chain fixed to where inflation can be okay. I don't care if the government keeps printing money, but the supply chain stays active and supplies everybody with enough of what they want, then there isn't pressure to raise prices. When there's shortages and backlogs, that's when prices go up. And that's what we're seeing with a lot of the chips and AI and infrastructure and some of the stuff that's going on with these data centers and things like that. There's backlogs, and which is increasing the prices of things, which looks like there's a whole bunch of future growth in these companies with earnings and profits and all that kind of stuff. But that might play out differently as other companies compete in the space and create more supply. But going back to the inflation picture, is I don't know how to get out of inflation without raising interest rates or stopping the money printing process, which I think the government, anybody who's got money in the market, wants to continue to have. So they might be at odds a little bit. Yeah, we'll see. I wish there was a way to just get it balanced, but I don't think there's a way to get it in balance again until there's a massive market correction and a recession and a lot of people kind of getting hurt before they can go back and regroup and reset. That's what they call a recession, reset. It's a reset period. And we haven't had a good one in a long time. We might have some inflationary pressures that made it look like there was a recession, or we had some job losses or unemployment that made it look like a recession in certain sectors or certain aspects of the economic numbers. But we really haven't had that recession that corresponds or is actively happening with a market correction or market crash, where people actually have to restructure fundamentals in the market. And there haven't been fundamentals driving the market for a long time. It's been really just who wants to throw money at what stock and make it go up, and who's taking money out of another stock that makes it go down. If we could look at the long-term picture, stocks are so far out of whack and out of value that if history repeats, and it always has over decades and decades, hundreds of years, we will likely see a market correction so that we get back to equilibrium where it comes to valuations, price earnings ratios, earnings, and things like that. Right now, we've got a lot of AI hype, a lot of things that are driving the market, making Wall Street rich, and it's making a few people with big 401ks better off, but that money could be easily gone if there's a big market correction. So it's always good to take profits off the table if you're nearing retirement. It's always good to look at the forces that are driving the economy. One is the constant growth of GDP, and the higher prices of oil mean inflation, which probably means higher interest rates, which mean there might be a catalyst for a market correction.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management right here in Tucson and Mesa. Our show, of course, is called Premier Retirement. Later on, we're going to be answering listener questions and then talking about gifting to children. But before we get to that, I want to remind you, if you're within 5 to 10 years of retirement or you're already retired, this is not the time to be making financial decisions based on cable news headlines or social media opinions. Inflation, taxes, market volatility, rising debt, and geopolitical uncertainty are creating challenges that most retirees have never faced before. That's why Jeff here and the team at Premier Retirement Planning and Wealth Management are offering a complimentary retirement roadmap review. They'll help you understand and evaluate your income plan, investment strategy, tax exposure, and overall retirement readiness. Find out if your current plan is built to withstand inflation, market volatility, and whatever surprises the future may bring here, especially in the next 30 days. To get yours entirely complimentary, call 520-780-9059. It's not going to cost you anything. 520-780-9059. No cost, no obligation. You can also visit us online at premret.com, premret.com. Jeff, let's get back to our conversation about things to look out for in the next 30 days. Oil prices, of course, on everyone's mind at this point, the conflict in the Middle East. If in the next 30 days, Jeff, that problem is solved, do you think that everything else is going to fall in line? Is that going to be the thing that just makes it all okay again?
Oh, there's so many people that want to cause problems and make Trump look bad. I don't think that could make everything go away. I mentioned earlier, I said there's also the supply chain. Oil makes everything more expensive, obviously, and I don't think that there's any such thing as Iran bowing down and saying, okay, we're done fighting. They've been wanting to have this war for 47 years, and we finally said, okay, come on, let's go. You've been threatening us, and now you're in a position to do some damage, so we're going to stop it. So, yeah, we're doing what we have to do, and Trump's been very gracious and giving him many opportunities to just say, you know what, that's probably a better way to keep our country alive and well and keep our citizens thriving economically and actually living in the real world. But they don't care. They just think death is an honorable thing, and dying for your country is even more honorable, and killing the U.S., as many U.S. and Israeli citizens, is a good thing. So we're at odds. I don't think it can be solved in a month. That's just my maybe negative attitude about the Middle East. And I think it's not like I haven't grown up for several years watching what's happening over there. It's not a new thing. So what do we expect? Do we think we're going to go in and keep doing the same thing over and over again, but this time it's going to be a different result? I don't think so. But back to it, if we could solve the problem in 30 days, would it be instant? Would things go down? Well, maybe food would go back. The thing is, usually when inflation happens, the prices of things just stay up. The only thing that does actually go down is the price of oil, but the food in the grocery store doesn't seem to really go down. The cost of a bicycle or a car or a computer seems to stay up there. Even housing prices haven't really gone down much, even with the higher interest rates. They've softened a little, but nothing super significant, in my opinion. I mean, they were way overvalued. They've come back, I guess, significantly if you look at the percentage, but considering that they're still out of range for most buyers, it really hasn't fixed the problem. So what's going to happen if oil gets back to a normal price? Well, we'll probably take more vacations where we drive, or maybe we'll be able to afford an airline ticket because fuel's cheaper. But I don't know that it's going to make things better. And I think that's why inflation is probably the most dangerous economic factor for retirees on a fixed income or has a plan that doesn't have a lot of buffer built into it. Because even though you spend less as you get older, it may not keep up. If you look at 10 years ago and the inflation that's happened since then, especially the 30% or so when Biden was in office, you're looking at things being about 40% more expensive to have the same exact lifestyle than it was 10 years ago. And 10 years might only be about a third of the way through somebody's retirement life. So what if it keeps doing that? Then you're going to spend 2 or 3 times for doing the same thing. Well, here's the good news is people don't do as many things. They probably do a third of the things, discretionary things, in their 90s as they did in their 60s when they could run and play and fly and go places and visit grandkids and do tons of stuff that costs money. They stop golfing, stop going out to eat all the time. They just kind of slow down. So thankfully, the inflation is offset with lifestyle changes just as we get older and more tired from the go-go years to the slow-go years to the no-go years. That kind of helps out. But every time there's an inflationary period, it's not like we have deflation. They talk like it is. Remember when Biden had inflation was like 9 or 10%. It was up like 25% the first couple of years. And they go, oh, inflation's going down. It's only growing at 4% now. Inflation's going down. No, it's still growing at 4%, compounding on top of the 20% that already happened. And right now, the 3% or 3.8 or even 4, if it gets back up to that, and we might see that in this next report. What does that mean? That's on top of the Biden era inflation plus last year, which wasn't too bad, but it's still 2 plus 4 plus 5 plus whatever it is, compounding, adding on top of prior year's inflation. What I have seen is people seem to spend the inflation on Social Security and about a 2% or a 3% inflation on income is reasonable to keep up with even a 3 or 4 or 5% inflation rate because, again, you become a little less active. You spend a little less on stuff. You have more paid off bills. Maybe you downsize your house. Maybe you don't have a payment anymore. Maybe you're not putting your kids and their kids through college anymore. Your kids are doing that for their kids and grandkids now because they can. So you have to kind of see how the plan works out, what your family situation, what your expenses are going to be. But yeah, inflation's a big deal. And unfortunately, just because oil goes down and prices don't increase at the same rate, it doesn't mean that the increases that have already happened don't affect you. They kind of are stuck there. The money you spent even last year at a higher price to get something, even if it does come down in value, that money's still gone because you already spent it at those higher prices because inflation caused you to do that. So yeah, inflation's a pretty dirty word, and oil is a dirty word in the sense that it correlates with inflation and causes a big bunch of it. Now, the other thing that causes inflation is bad monetary policy by the government, like printing money and making all their cronies rich and generating tons of wealth for the haves, and the have-nots have to try to catch up. They keep taking the tax money of the middle class, and I'm not going to join the mantra of tax the rich, tax the rich. It's not. Pay their fair share. I think they do pay their fair share. They pay a ton. But at the same time, it takes money to make money, and those people in inflationary periods, typically people with money, make out fine. It's the people that don't have money, the lowest 50%, the middle class, the lower middle class, that don't have assets that grow with inflation because their assets don't grow because they don't have any assets. Just the cost of living grows and their income typically doesn't keep up. So that's what's causing the separation of classes. I wish it wasn't so. I wish we could get inflation under control, keep it around 2%. I wish the government would back off on this quantitative easing program, which they think is just an easy fix for everything. And why not? It helps their families, it helps their friends' families, and helps the rich people get richer. And again, I don't mind rich people. I like to associate with them. The thing is I think we're forgetting the middle class a little bit with some of these policies.
Jeff, you were talking about inflation. I looked it up there. Under 4% is not bad when you consider that in June of 2022, inflation hit 9.1%. We're talking about things to consider here in the next 30 days. What do you think is the most important thing that someone listening to the program can do here in the month of June in the next 30 days?
Well, if you put in the context of inflation, investments, and things like that, the worst thing about inflation is if prices are up and you lose money in the market and your assets go down because of a market correction, then all of a sudden you're spending more money to get by, and that's more of your money that doesn't respawn or rebound in the next market correction. So I think having a plan that guarantees at least your subsistence income with an inflation factor over and above what the Social Security will give you would be a good place to start, and have a plan where that income is guaranteed, where you take some principal protection, but you're able to have assets in the market that do go up. Sometimes the inflationary pressures do make the market go up until the Fed raises interest rates, and then it hurts the market. So as long as you have a monthly paycheck coming in paying all your bills, you're in much better shape dealing with inflation than you are if you're expecting the stock market, which has been going right along up as long as inflation has been going up. But if inflation gets out of hand, they have to start raising interest rate, the market goes down, then you're in trouble. So the biggest deal is have a plan where you don't get in trouble, plan for the worst, hope for the best, but don't forget to plan for the worst. I mean, if you don't plan for the worst, you'll get caught up and you'll end up being like Norm, who had all his money at risk in the 2000 crash and never recovered. And 10 years later was wondering why he's going to run out of money in his 70s instead of live his long life out like he could have if he'd have just restructured his plan in the beginning, or even took some evasive measures even while the market began to get a little ugly. There's a lot of things that we see very similar now to what was happening then. My job is to make people not feel like Norm or not ever become a Norm. And nobody should want to be the norm, not that Norm.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. You've been listening to the program today. You're interested in sitting down with Jeff and talking about your individual situation, and you're wanting to find out what this retirement roadmap is all about. Well, you can get it by calling 520-780-9059. Now, you can make that call if you want this weekend. Just leave your name and telephone number. Shelley will be happy to call you back Monday of this coming week and talk to you about getting in and when is a convenient time for you to sit down with Jeff. Again, no cost, no obligation. Probably about an hour or so you should budget for this, and we'll begin to design this plan for you. And again, no cost, no obligation. 520-780-9059. You can also find out more about the firm online at premret.com. Jeff, time for a break. News, weather, and sports. When we come back, we've got listener questions, and then finally, how you should gift money to children if you want to do that when our program continues here on 790 KNST. We are Tucson's most most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thanks so much for making us part of your weekend. We really do appreciate you joining us every week here for Premier Retirement on 790 KNST. We're on the air for you 4 times a week for your fiscal fitness and your financial education. We're on Saturdays at 7 a.m., 9 a.m., and 1 p.m. Also, Sundays at 11 o'clock in the morning. And as always, if you have missed any part of our program, you want to hear it again, or you want to hear the whole show all over again, or hear some of our past shows, they're all online wherever you get your podcast. Search for Premier Retirement with Jeff Vogan. You're going to find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Our phone number today, 520-780-9059. Do you hear anything today that piques your interest? You'd like to come and sit down and talk with Jeff on a one-on-one basis to talk about your journey towards a confident retirement. We can talk about almost anything that you want to talk about. There is no cost and no obligation. Again, 520-780-9059. You can also visit us online at premret.com. That's premret.com. Okay, Jeff, it is time for listener questions, and we've got some good ones this week. Ed is in Rita Ranch, and Ed says, I'm 62 with about $1 million in IRAs, $700,000 in a brokerage account, and about $150,000 in a Roth IRA. Conventional wisdom says to spend taxable accounts first, but since my pension and Social Security cover my needs, and I expect to leave money to my heirs, would it make more sense to spend down my IRA first to reduce future RMDs and leave the brokerage account with its more favorable tax treatment to the next generation?
Well, the Roth IRA has a really good tax treatment. I definitely try to build that for legacy and be aggressive with that and don't touch it. But yeah, I'd spend down the IRA money first. That makes total sense. The $700,000 in a brokerage account, that could get you into trouble depending on how it is. If there's dividends or if it's in a mutual funds that generate taxable gains every year, a lot of them ordinary income, you might find yourself creeping into a higher and higher tax bracket while you live, even though there might be some step up in basis left depending on what you own in that $700,000 brokerage account. The other thing is, if you ever did need that brokerage account and sold something, there'd probably be some sort of a tax liability. It could be a surprise, could kick you into a new tax bracket, could kick you into a IRMA bracket where you pay more for your Social Security. You're not old enough to know about that yet, but you will soon. So there's a lot of things where big brokerage accounts can cause a lot of trouble too. You might try a direct indexing program where you balance out some of the gains with some of the losses at the end of the year. We manage those here. If you are trading, if you just got some buy and hold stock, you bought Apple in your 30s and you just kept it, and that's the $700,000. Maybe you doesn't pay a big enough dividend probably to get into tax trouble. And if you want to just leave that as your legacy, then fine, do so. If you want to take profits or redistribute those gains into other up-and-comer stocks and make even more money as a legacy, you can do that as well. I mean, if you like to step up in basis because the tax treatment is better on inheritance, and while you own it, you may be able to pay capital gains at a 15 or 20% bracket instead of ordinary income on that 700. I don't know what your other income sources are, so I don't know what tax bracket you're going to be in. I do know that you'll probably be well past the 12 bracket into the 20s, just with the RMD that you're going to have to take out in 10 years. So that plus Social Security, pensions, or whatever you might have, I'm guessing that you're in a moderate tax bracket at least, maybe a high tax bracket, but I want you to get into a high tax bracket. The other thing you might want to do is take some profits out of that $700,000, pay taxes. If you're getting ready to retire, I didn't say what your retirement date is that I'm remembering on the question. You're 62 with about $1 million. Maybe you'll retire in the next few years. Maybe you want to wait and do some Roth conversion on some of that IRA as well, depending on if your Social Security and your pension cover everything. So you might also consider a LERP, which gives you a big death benefit. That $700,000 could become more than $2 million in death benefit, tax-free, no fuss, no muss. And you could also borrow against that death benefit if you did need that money, and it would never kick you into a new tax bracket. I've talked about LERPs, a very tax-efficient way to use your own money. It's kind of like making your own tax-free bank. You own the bank, you own the money, it grows at an interest, and you borrow from yourself at a rate lower than it grows on average. So, that's the whole thing that makes a LERP work. And if you like that idea, if you like a Roth IRA, you might like that with some of your after-tax money, and you never pay tax again. You never get hurt taking profits. And again, right now, the most you would pay on any of that $700,000, depending on your current tax bracket, would be 15, maybe 20% in taxes, because most of them, I assume, are probably long-term. And if they're not long-term, then You might want to just convert it, pay the taxes as you go. You probably don't have a basis that you need to worry about. And maybe you could convert it into something a little bit more tax efficient if you wanted to, or manage it in a different way to be tax efficient. But you're on the right track as far as thinking, what money do I spend first? Yeah, spend all your taxable money or the one that's going to cause you a future unknown tax, because we don't know how much taxes are going to be raised in the next 10 years or so. We don't know how much that IRA is going to grow to. We don't know what rules on RMDs might change. You know what the tax rates and the tax brackets and your tax situation is now. If you can work within the framework of what it is now and get all your money into a place where it's either taxed at a really low rate or not taxed at all, and if you can do that in the next few years while we know what the tax plan is, then we don't care what government does to the tax rates. We don't care what they do to the rules on IRAs, Roth IRAs, or capital gains, or the step up in basis that is intact now but might not be when you die. That's still 30 or 40 years potentially away. And a lot can happen with tax code, and a lot based on how in debt the country is and the direction that we're going and digging a deeper and deeper hole. I have a feeling that taxes are going to be less favorable in the future than they are now. And you might want to take advantage of what I consider one of the most favorable tax environments we've been in forever, at least since I've been alive. And a great time to take advantage of tax planning and set yourself up for a tax-free income for the rest of your life.
Ed, very good question. Thanks for listening to us in Rita Ranch. And if you would like to further this conversation with Jeff, it's 520-780-9059. Again, there is no cost and there is no obligation. Okay, Jeff, Don's listening to us in El Conquistador, and he writes, my wife and I are 49 and 50, debt-free including our mortgage, and we're saving 20% of our income in retirement accounts while still helping with college expenses. We hope to retire at 62 with about $2.5 million saved. But we're concerned about health care costs before Medicare and making sure that our money lasts. What steps should we be taking now to improve our chances of retiring at 62 and not outliving our nest egg?
Well, I don't know what your income is, so I don't know what the 20% equates to, but let's just say if I'm going to assume you have $1 million now saved, mostly in 401ks, retirement plans, you're going to keep saving 20% of your income, maybe into 401ks, maybe into other savings. You're going to grow those assets for the future. Healthcare costs and Medicare, one of the things you have to worry about is eventually you're going to have to take, if those are all IRA dollars and they continue to grow, if you're going to retire like in your 62 and you still have another 10 years before you have to take RMDs out, you might have $5 or $10 million in that account. You don't necessarily have an income plan. You're going to be subject to the whims of the market, the ups and downs and the volatility. So some of the things you can do now at 49 and 50, which I think are really good, is take some of the profits off the table. If you're going to invest 20% of your income into retirement accounts over the next 10 years or so, I think you ought to dollar cost average into the market, be real aggressive with that money, because it doesn't matter if it goes up or down. You're still in accumulation phase for at least 10 more years, or maybe at least dollar cost average for at least 5, maybe take some of the profits off the table. But you might want to take what you've saved already off the table, because the market is historically really high. It keeps making all-time new highs. And by the way, we just sent out an article. We do like weekly emails, and I was just reviewing the last one we sent this week. And it was like every stock market crash came right after the market was doing really well. I mean, the markets don't crash after the markets are doing badly. The market crash comes as a big, huge surprise. And oh my gosh, what happened? And that's why they call it a crash, and nobody expected it when the market is high. So we might be on the verge of the next one, and the market will probably look like it does today before the next market crash. Whether that happens tomorrow or next year, or 10 years from now, I don't know. But bottom line is you never get hurt taking a profit. So you might want to set up something that will help you, that you can retire at age 62. And that might be set up an income annuity. Let's say you have $1 million, you could take that off the table. You're going to save another $1 million between now and the time you retire. That $1 million that you save will probably grow to $2 million. So you'll still have $2 million in liquid capital in 10 or 12 years. You could have another $2 million in income benefit, which would generate $100,000 or more in guaranteed income. And you could do that with your $1 million that you have saved now, assuming you have $1 million saved. If you have less than that, you could still take some of that profit off the table. At today's levels, you might want to consider doing that if you have access to 401k or IRA money. You may not. If you're still working, you're kind of in a rock and a hard place. You might have to wait to do this. But if you're in a position to take some of those savings out, lock them in for profits, and set up a future retirement income, or in other words, a self-directed pension that you own, that you still have access to the balance anytime you need it, unlike the pensions that work gives you, where if you die, you're out of money and you only get what they tell you to get, and you can only get it when they tell you can get it. You can be a lot more in control if you did it yourself. And the companies that run pensions are the same companies that offer these retirement annuities that are basically self-directed, self-owned pensions. So you might want to look at that. I have a lot of really basic information from you, but if you're like a lot of clients that I meet in your age bracket, it's a great time to start preparing. You also might want to consider some of that income into retirement accounts, you might want to consider loading it up instead of into a deferred account that's going to cause you a future tax problem, maybe loading some of that into LERPs for the next 10 years. Maybe you get yourself another $50,000 or $100,000 in tax-free income when you retire that never shows up on a 1099, that doesn't push you into a Medicare premium cost and things like that. I mean, I'm concerned about the healthcare costs, not just before Medicare, but during Medicare. Medicare, you have to pay Part B, and if you have good income and it shows up on a 1099, you're going to pay double or triple what your neighbors and friends pay for Medicare Part B. So again, some of the tax planning that we do is not just about the tax rate that you're in, but also all the other ancillary charges that the government dings you with if they consider you in a high tax bracket. So you might want to shelter some of that 20% of your income that's going into retirement accounts now. You may wish to pay taxes on that now and either go with the Roth version or consider a LERP, which is a non-qualified asset and gives you access to take money out of it prior to 59 and a half without penalty. If in fact you needed money, since you're only in your early 50s now, you may need money in 5 or 6 years because of a emergency or some sort of an expense. And then you don't have to take a loan against your 401k. You can actually borrow against yourself and make money on that account that you borrow. Again, there's a lot of ways to skin the cat. There's a lot of ways to build your financial house. Most people your age have never heard about anything other than a 401k and some mutual funds that they have in a non-IRA account. Maybe you've heard about Roths. Maybe you heard about the benefits of funding them now. Maybe you like the tax deduction because you're in a high income bracket. But basically, people in your position generally, and I don't know what your history is, you might be very well versed in other aspects. But if all you know is securities, you might want to explore the world outside of that for retirement income planning rather than wait till you're 60 or 62 and say, okay, now what do I do for income? You can start getting way ahead of the game if you start earlier.
Don, great question. Thanks for listening to us in El Conquistador. Again, we could use just a little bit more info to give you a better answer. If you'd like to furnish that to Jeff, call 520-780-9059. Next question, Jeff, is Jerry in Bear Canyon. Jerry says, I was wondering about the pros and cons of depreciating a rental property. I just moved into a new home, have a single family home that I'm going to be renting out that is worth around $500,000. Should I depreciate the home over the years or not? What are the tax implications? I don't see myself ever rolling this property into a 1031 exchange. Thank you, and keep up the good work.
Thank you. I think the 1031 exchange might be an option if you ever did change, but if you just want to leave it to your heirs, and if you think you really want to be a landlord till you die, which I believe you'll probably change your mind down the road because most people do, and end up wanting to sell out, take the capital gains. But here's the cool thing about depreciation. I would depreciate as fast as you can because you get an offset against ordinary income when you depreciate it. When you sell it, it'll be treated as a capital gain because it'll be a profit. So you actually get a more favorable tax treatment on the sale generally, if you do it right, and you get some depreciation while you're offsetting current income from other sources. I didn't read here how old you are, so I don't know how close you are to retirement or if you're even still working, but you've got a nice rental property. It's a nice asset. I guess you could always sell it if you needed access to capital or you needed liquidity and something else with it. But if it's generating good cash flow and you can depreciate it to offset against that income, then why not? So anyway, it's up to you, but I think you're on the right track and you're asking the right questions. I don't know enough information to give you the final answer, but I think you're on the right track.
Jeff, let's say that Jerry is age 65, and by the time he's 70, he's tired of being an active landlord. What are the options that he has available to him?
Well, I mean, you could always just sell, downsize, and pay the taxes and move on. You know, honestly, for people that are healthy, we like LERPs because you can end up generate tax-free cash, get some appreciation, just kind of use it as a bank. The other thing you could do is if you want to go through that 1031 exchange step, now there are some rules. You have to know you're going to do it before you sell it. You can't just sell it and say, okay, now I'm going to reinvest the money. There's no 60-day rethink it rule like an IRA, but there's a 1031 exchange program, not just to another rental, but you can do it through a kind of like a real estate investment type trust. It's called the Delaware Statutory Trust, DST. That gives you the ability to basically buy into a pool of real estate, not really actively manage it like you might now with your home, but that there's a residual income that you can get and it preserves the taxes or the taxability of that asset. So you can put it in the DST, still make a reasonable rate of return until you die, and then you get a step up in basis. So the asset that you sold, the house that you sold, let's say you sell your $500,000 house for $1 million 15 years from now, or maybe 20 years from now, whatever it is, you really don't have any other options. You don't want to pay the taxes on that big gain because you've depreciated to zero. You don't want to pay taxes on $1 million. So you just move it into a DST, Delaware Statutory Trust. Maybe you make 4 or 5%. That's not a whole lot of money, but if you don't have to pay taxes at 20% on $1 million, you save $200,000 that you get to pass on to your heirs in a few years, especially if you're getting older and you think you're in bad health, you're not going to live another 100 years or 20 years or 10 years or whatever. So again, based on your situation, your health situation, what you want to accomplish with taxes, do you want to pass on a tax-free benefit to your heirs? Is it worth just not managing it, but still going through the hoops of doing a 1031 exchange into something that's another rental or investment property, but not when you have to manage, not when you have to get calls for in the middle of the night from your tenants and fix toilets and get bothered while you're vacationing and things like that. It's more of a passive investment that you can roll active investment property to if you just get tired.
Jerry, good question. Thanks for asking it from Bear Canyon. We appreciate you listening to us. And if our listeners do have questions, they'd like to sit down with you, Jeff, on a one-on-one basis and get those questions answered. We are offering the Premier Retirement Roadmap. Absolutely no cost and no obligation to get yours. And to have that in-person consultation with Jeff, call 520-780-9059. It's 520-780-9059. You can also find out more about us online at premret.com. Gifting money to adult children. Jeff, this is something that we come across once in a while. People will ask us that question, should we give it now or later? And a lot of retirees tell me that they would rather see their children enjoy the money now rather than wait for an inheritance someday and maybe watch them enjoy that money while they're still alive. Does that make sense always, Jeff?
Well, it doesn't always make sense. There's no such thing as always. There's nothing that works always. Never and always are really words you can't really use in the money business because there's always an exception. Sometimes retirees have an abundance. They have a good plan. They have good pension. They know they're never going to run out of money. They have an excess. I think that excess is totally on the table to give away and see your kids have some fun and enjoy the money now rather than wait for the inheritance someday. However, I have way too many experiences where I've received a call or been in an annual review and found out somebody just took out their retirement asset that was in their plan and bought their kid a house. And they'll never get that money back for the house. And then that money doesn't generate the income that we had planned it generating 5 or 10 years down the road from now. And that person's going to be left hanging as soon as they run out of their savings that they're living on, where we plan to use that other asset for their own income. So sometimes people shoot themselves in the foot or basically ruin their retirement plan because they're so bent on helping somebody, because it seems like everything's okay today. But if you've got 20 or 30 years still left in your retirement life that you have to spend your own money to live and to pay your bills, then I wouldn't give away or jeopardize that by helping one of your children out. I mean, you got where you got by saving and by being responsible with money, unless it was maybe your parents gave you a bunch of money. Maybe you feel obligated to give it to your kids too. But most of us in our generation that are getting towards retirement and have kids that are adults want our kids to learn the same type of thing that we learned, and that is how to save, how to live within your means, how to make wise money choices. Sure, we'd love to give our kids the fat lifestyle that we're receiving now in our 60s after we've worked really hard and been poor most of our life, and we finally are able to enjoy the fruits of our labors. And now, because we love our children, we just want to give it away at our expense? No, I think that's a bad idea. If we can give it away and retire on our terms, knowing that there's no situation that isn't insured and secured from market fluctuations, from a healthcare crisis, from an unknown expense, air conditioning going out, even something little like that, or just having to maybe help a child get through an emergency rather than just give it away now so they all have fun. What if somebody has a real issue where you really want to come up big and help, and now you don't have any money left? So it's not just about, will I have enough? It's, will I have enough to do those things that are more important that I might be able to do for my family later in a time of crisis or a time of greater need? Or is there an abundance enough to where if we're living well within our means, for example, if you've got an income plan that's guaranteed at generating $180,000 a year and you can comfortably live because you have no bills on $10,000 a month, which is $120,000 a year, you've got $60,000 in discretionary income. Spend that on Disneyland trips, spend that on fun stuff, spend that on Christmas bonuses or whatever, because you're going to have that $160,000 coming again next year and you'll be okay. You've also got some savings in your Roth IRAs and your 401ks, your IRAs, your alert plans or annuities and other things that maybe you're not even touching yet. So if you've got a plan like that, then heck yeah, enjoy it. I love seeing my kids enjoy their lives early. I also don't want to deprive them of the frustrations and the struggles that make having money important and rob them of a sense of accomplishment if you give them too much too, I think. So again, it's all up to you and your values, all up to your family and their needs. But I think there's a happy place in between for most families where they can give a little now, make their kids' lives better, see them enjoying some of the hard work that they've done without depriving them of the life experiences that they need, and also without getting yourself in trouble where you don't have what you need if something bad happens.
Jeff, a lot of people worry about gift taxes. Maybe they want to give their child $40,000, $50,000 for a down payment on a house. What are the rules that listeners should know about giving cash?
Well, the gift tax I think the biggest misconception is people think if they give their kids money, the IRS is going to charge them a tax on it, like right now. They don't. It actually just uses up your unified credit, or basically your lifetime exemption for estate taxes. That's death taxes. Right now, I mean, that level's upwards of $40 million almost. So it's stupid high. That's if you have a trust and things like that. But they're looking at lowering it. So if you maybe have $3 or $4 or $5 million, maybe you'll have an estate tax. And if you try to give away too much money to your kids, more than $19,000 per child, by the way, each spouse can give $19,000. That's $38,000 total. And you can give it to all your kids and all your grandkids. So if you wanted to help your kids buy a house and they have 3 children, technically you can give about $150,000 away to your child and their kids. Or if they have a spouse, maybe there's 5. So you might have close to $200,000 in gifts that you could actually give away. But you just have to make sure you document it, because if in the future they say, hey, you gave away assets that we deserve to be taxed on when you die and you broke the rules, then it's good to just have that understanding. But most people, if you're going to live on what you need to live on, have a nice retirement lifestyle, leave a few million to the kids, like the typical person in retirement that's wealthy or even affluent, but not super rich, is probably not going to be in a situation where you have an estate tax problem anyway. If you give away money, then somehow you're going to be dinged for it later. One thing you can do is, if it comes to just having fun, I mean, you could go on a family trip and spend all kinds of money. I remember we spent tens of thousands of dollars on a Disneyland trip for everybody, Disney World trip a long time ago, that all our grandkids went on. Now we've got 14. Shoot, we could probably blow through 50 grand easy in a week, and wouldn't have to really divvy it up or call it gift taxing. It's just spend money on a vacation and we invite our grandkids. So what? That's not a gift. But if you just hand them a cash or write them a check and say, here, you can do this, just keep the documentation so that if ever does have to be reconciled with your estate taxes, it's there. But honestly, don't be afraid of that deal. Don't be worried about that rule unless you're already probably in that $8 or $10 million range or more, and you think you might go into an estate tax problem level in the next few decades before you pass away.
Jeff, what do you think about grandparents using a 529 plan to help pay for grandchildren's college?
Well, first of all, I like the idea of helping grandkids pay for college. You could actually write a check out of your own investments directly to the institution and to the bookstores, and my understanding you still get a tax break for that. But I also haven't seen a 529 plan that really grows at a rate that impresses me. The fees are typically higher. I think it's just one of those little money makers that feel good. So brokers and people in the financial business can sell a bunch of them because everybody's got a bleeding heart for their grandkids. You can put a whole bunch of them together. I'm sure the mutual fund companies and brokerage firms offer bonuses when you set them up because the fees are typically a little higher. A lot less efficient on those, honestly. My favorite plan to deal with college kids' education is to have a LIRP, life insurance retirement plan, where you put money in a tax-free account and you can borrow it tax-free, pay the bills. It doesn't put you in a new tax bracket. So it's basically tax deferred. If you're one kid who you've got the 529 on doesn't end up going to school, you don't have to find another kid to give it to or treat it like an IRA or a tax deferred account where you cash it in and you end up paying the taxes on the growth later, which is probably meager growth compared to most other assets you could have put it in, like 401k growth fund or a IRA with some upside, more upside than the 529s, at least that I've seen. I'm still waiting to see one that performs better than a typical portfolio. But the idea is good, but there are other ways to skin that cat. I like LIRPs for that. I even like some annuities allow you to borrow against them. You could even use loans from your 401k to borrow against and still make money on your money and have the ability to grow that asset. And if you look at the extra money that you make, perhaps on your 401k minus the taxes you might have saved on a 529, an inefficient 529 plan, you'd probably be better off anyway. And you'll probably simplify your life by not having the 529s. I'm not totally negged out 529s. If you have them, great. Use them to the best of your ability. But you probably won't find me trying to sell you one if you come to my office. I would show you how to fund your grandchildren's college educations a more efficient way. That gives you more tax benefits, more flexibility with the money, and doesn't lock it in for each kid. But it could be a pool of funds where you can use for any kid at any time for any type of education, depending on whatever rules you want to impose on those gifts or those funds.
Very good conversation, Jeff. If our listeners have questions about gifting to children, they can call us here at Premier Retirement at 520-780-9059. No cost, no obligation. We'd love to sit down with you and have a conversation not only about that, but anything else that we've talked about on the radio show today. Jeff, out of time for this week. I'm going to thank you for your time, but most importantly, as I do every week, I want to thank the fine citizens here of Tucson for listening to us. So for Jeff Vogan, I'm Jeff Shade, wishing you a great weekend. Be sure to join us again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.